Okay guys, it's a Saturday and I just wanted to make a video on actually losses, not winners. I mean, a lot of my videos have been showing winning trades, but I don't think I've shown much of my losers, so I'm going to do that. Um, Now, the key to making money, really, is managing your losses. You're not going to be a successful trader if you cannot manage losses. So I'm just going to go over 3 trades I made this week that were losers. So let's go to the first one. And this was an oil trade. Maybe I should zoom in right here into a 3-minute chart so it's easier to see. Alright, right here. So this is what I was looking at in oil. Okay, I had a bounce area sort of forming here. Wasn't the nicest, but it was still a bounce area. And oil at this time, you can see on the profile, the value in oil was shifting higher. Maybe it's better to see with this. Yeah, value was shifting higher, so I wanted to be really on the long side. So what I did was I purchased one contract of oil right here, and my expectation was for it to reverse from here and break up to the outside. I was looking for the low of the day. It was the first hour, so there was a 60% chance that the low was going to be made. So I got filled, and I just put my stop a few ticks below this low. It came up to the high volume node, which you can take your first target off, but it didn't. I was expecting to the top side, and as it came back down, it stopped me out. And I only took a small loser of about $100. The key, like I said, the key to trading is managing your losses. Usually, when people see a gain coming through, like I had at one point in this trade about I would say $300 up. They say when it starts coming down, oh god, now I'm on the losing side. I'll lower my stop. It's gonna come back up. And they lower their stop, and then they lower their stop, and finally, oh, the loss is too much, and they get filled right at the low. And then they watch it and in turmoil, it go right back up. And it's just what happens to every trader. But if you manage losses correctly, that type of emotion won't happen. So that's one example of a losing trade this week I made. Second one was in the euro. So no, sorry, it was in the Russell, right over here. The Russell was making a bounce area, as you could see, and this was actually Friday. Even though the Russell was in an uptrend, it's shown clearly. You could see yesterday at the close we had this bounce area form, and then at 4:30 the Fed reported. I think they increased the discount rate by 0.5, and you could see the market had a negative reaction to that. So when I woke up today, I said there's a lot of sellers in here. A lot of sellers who are going to defend their position over here, which means they're going to sell another contract. So I'm gonna join in. I'm gonna sell the 628s with a stop just above the high, a few ticks. Maybe I think it was up there somewhere. And my expectation was a return down to here. This time I was just completely wrong. It didn't even really go in my favor. It just went right up. And because I know in the back of my mind, using this strategy, I'm gonna get a trade that's gonna make it all back, I said, oh, the trade didn't work. This is not a losing trade. This is just a trade that didn't work. A losing trade is when you add to a loser for no particular reason except emotion, or you move your stop up and up and up for no particular reason. That's a losing trade. A losing trade is also a trade where you take profits too early when there was no indication that you should have taken profits out. That's actually a losing trade in auction market theory. And last but not least, my last trade was in the euro, and this trade was Thursday afternoon, and it was I thought this was going to be a really nice trade, so I'll show you what happened. So anyway, here, let me just actually, this is what I was looking at when I executed this trade. We knew we had a very important low here, so there's obviously a buyer today. You can see the buyer as shown by the volume spike on the up move, volume spike on the up move, and then balance forming at a higher point. So I took a long position right there, and it was I think 3:30, and it started going up. And I was like, yes, I was gonna add another contract if it broke up here. Looked like a nice trade. Looked like it could have got brought up to the point 3,750s. But then, as the market closed at 4:30, when it doesn't reopen, my data starts flowing in again at 4:30. We had the Fed report come out. Well, an unexpected Fed discount rate increase. You could see how it just tanked right through everything, made all-time lows, well, not all-time, I think year lows, and just started falling. Yet I only took a $112 loser because I had a stop in. I put my stop right here. If I didn't have that stop, because I went to go get a snack, and I came back when I think I was trading down here. If I didn't have a stop, it wouldn't have been a $100 loser. It would have been a $2,000 loser. So that's just one thing to make sure everyone use stops. If you don't use stops and something like this happens, you could be having the best winning streak of your life. One trade where you forgot to put a stop in, and you have a report like this come out, you're killed. So always have a report. Always have a stop it. So really, that's all I wanted to show. Some losing trades and how to manage stops. I mean, if you're having a balance area form and you want to buy at the lower end of it, well, don't have your stop down 100 ticks below the low. Just have it below the low, a few ticks below the low. Because if it breaks that low, then it just means the trade was invalidated. It doesn't mean it's not a losing trade, because that trade could have just went exploding higher. It just means the trade was invalidated and the market said, no, I'm not going to go up, I'm going to go down today. There are times, though, where the market's going to do this. You have your balance area form. Okay. And then you see price fall in. You bought it around here. Stop you out. And then do one of these. Well, when you see sometimes actually my most successful days are when I get stopped out first on one of these and re-enter. Because if the market, it was in a balance area, broke out this way and comes back in, there's a 90% chance it's going to come and go to the other side. And that would be a great example. So let's say you bought it here and it gets stopped out, and you go and you feel, oh man, I lost money, I don't want to keep trading. No, it just did a stop run. So if it comes back up again, that trade idea was not invalidated. All it did was it extended the balance area low from here to here. It just made it a bigger balance area. And usually when it does that, it's going to break to the other side. So that's another way to make back some winners. The only time you should stop trading is if you know you're trading off of emotion. So thanks for watching. This, guys, will be in HD.